All right, good afternoon and welcome to GLI's COVID-19 Help Resource. I'm Sarah DeVasher Wisdom, President and CEO of Greater Louisville, Inc. We are very fortunate today to have valued GLI investors who are all experts in their field of work and are working to help their clients and our community through this crisis. They're going to walk us through some of the important tax provisions from the recent federal legislation of the CARES Act. Before I turn things over, I just want to give you an outline for how we're going to go about our discussion today. After a presentation from the MCM and Frost Brown Todd teams, we'll be taking questions from you. So please use the chat feature at the bottom of your screen, and our team will be sorting through the questions throughout this webinar. We're going to try to cover as many topics in the time allotment that we have for today. We are recording this webinar and we will be posting it on greaterlouisville.com. For the discussion today, we have Stephen Lukinovich, partner at MCM CPAs and Advisors, Rick Woods, partner at MCM CPAs and Advisors, Chris Kaufman and Daniel Mudd, both members at Frost Brown Todd. Not only are we thankful for their time today, but we are thankful for their continued investment in GLI. And with that, now I'd like to turn the presentation over to our team here.
Chris, did you want to make opening comments?
Thank you, everyone. I was just making sure we could get the PowerPoint up there. So sorry for a little bit of delay. Welcome. Thank you all for taking time to be a part of this discussion today. Again, to echo Sarah's comments, we'd like to try to cover a lot of detail, helpful information to get in your hands, to consider ways that create liquidity and cash flow for your businesses, and basically trying to take advantage of the benefits through the CARES Act that are available. Hopefully everyone's weathering stay at home well. When we started this process, I had hair and I was cleanly shaven, so hopefully you're weathering it better than me. But just want to work through a lot of detail. I know we're going to be throwing a lot at you. Would love for your questions and comments at the end. Hopefully we'll have sufficient time to address those and we can answer those questions as they come. But just want to move forward here. So as many of you I'm sure know, that's why you're here on this webinar. The CARES Act was part of the Phase 3 relief legislation that was passed in response to the COVID-19 pandemic. Really a lot of different elements involved in that legislation in an attempt to get individuals, businesses, the economic relief that they need to try to weather this difficult time. There's the SBA loan process. I know that GLI has had and others have had discussion about, and I know a lot of you considering. And what we want to focus on today is really those changes to the Internal Revenue Code that were implemented through the CARES Act and how those economic changes can benefit you or your business. So 2.2 trillion in economic relief, a lot of that through the loan program, then also through the relaxations, the credits, incentives provided through the Internal Revenue Code and the legislation. The first one we want to talk about today is the deferral of employer payroll tax payments. If you're familiar with the way the payroll taxes, employment taxes work on the employer side, you generally have the employer share of Social Security taxes and the employee share of Social Security taxes, both of those 6.2%, adding up to a total of 12.4. Then you get an additional 2.9% of Medicare taxes for a total percentage of 15.3%. The legislation that was passed permits employers to defer the employer the employer portion of that share, the 6.2%, and permits that to be for periods beginning when the CARES Act was enacted, March 27th, 2020 through December 31st, 2020. So it's a good way to free up some funds that would otherwise be required to be deposited as part of your employment tax compliance related to employees, making those deposits of the 6.2% amount of the Social Security taxes. And again, for the 2020 tax year, you're talking about 6.2% of the first $137,700 of wages for each employee. So roughly, $8,500 of taxes that can be deferred per employee by the employer. That percentage that is deferred has to be repaid. Half of that deferred amount has to be paid by December 31st, 2021, and the remaining portion of that deferred amount has to be paid by December 31st, 2022. So you don't, it's not a forgiveness, it's not an abatement, it's simply a deferral of otherwise required deposits that employers have to make. So it frees up that cash flow, that capital now, so it can be utilized for other areas of need. But understanding that 2021, 2022, those amounts will have to be repaid.
So this is a nice short-term loan, Chris, right?
That's
Free
correct.
money.
That's free money. Yeah, no interest charged. It just has to, the amount that's deferred has to be repaid. And again, you don't have to defer the entire 50%. You can defer a portion. The cap on that deferral is the 50%, the employer's portion of the Social Security tax. The second, and this is really kind of three changes woven into two slides here, but definitely an extremely significant change that really should bring about a lot of focus from businesses, meeting with your tax advisors and others to really consider how this could potentially bring some additional cash flow and liquidity into your business in a time when it's needed. And that is the temporary lifting of some limitations on net operating losses and business deductions that were imposed with tax reform in 2017. So when the Tax Cut and Jobs Act was passed in December of 2017, there were some limitations that were imposed on the deduction of net operating losses. Essentially, under tax reform, if you had an NOL that arise from a tax year after 2017, you couldn't carry that net operating loss back to previous years. Prior to that, you could carry it back 2 years and forward, a portion. But under tax reform, you couldn't carry back to a prior year, and when carried forward, that operating loss could offset no more than 80% of your total taxable income. You couldn't use that net operating loss to completely offset taxable income like you could prior to tax reform. So there was no ability to carry that net operating loss back to prior years, which was often very helpful to businesses where you had periods perhaps where you had taxes that were being paid, everything was going good, but then maybe you had a down year and you had a significant loss that couldn't be utilized in the current year. You could carry that loss back, maybe recapture some of that tax that had been paid in the prior years and use it in the business going forward. Tax reform, unfortunately, limited the ability of taxpayers to do that. What the CARES Act does is temporarily lifts those limitations imposed under tax reform. So under the CARES Act, corporate taxpayers can now carry back a net operating loss that was generated in a tax year after 12/31/2017 and before January 1, 2021. So essentially, net operating loss generated in the 2018, 2019, 2020 tax year can now be carried back to the 5 preceding years of the year that the net operating loss arises in, and can be used then to offset all the taxable income in those years with respect to that net operating loss. The 80% limitation is not in place. So that NOL carryback can be used to fully offset the taxable income. So to the extent you had tax years prior where you had taxable income, tax was imposed and paid, you could use that net operating loss to go back to those preceding years and recapture a lot of that tax to utilize now in the business. In addition, keep in mind for corporate taxpayers that prior to tax reform, you had a 35% tax rate. You had a much higher tax rate than the 21% tax rate imposed now. So again, there's the potential to dip in to those amounts that were paid at a higher rate and can be recaptured in the current year.
I said, Chris, one thing I've heard of since this is, be thinking if any kind of mergers and acquisitions you've had over the last few years, if there's any provisions related to carrybacks and who owns those, it's possible that could be up for grabs depending on how it's structured and what parties have those benefits and have those rights. So that's something that I hadn't thought of until someone had reached out and we looked into that a little bit and are looking into that. So that's something to be thinking of for businesses that maybe recently acquired a business or a division or something of that nature, if that could be in effect.
That's good, Daniel. I'll add maybe some obvious things to get this benefit, number one, you had to be paying tax in some of those years you're carrying back to. So that's one limitation on this. The other thing is you have to file for it. You're going to have to file your 19 and 2020 return to carry back those years before you can do it. 18, I guess, is already filed. But you're going to have to file either an amended return. Historically, the IRS had an expedited procedure for NOL carrybacks where you could file, for corporations would file an 1139, and then individuals would file Form 1045. And that was better than filing an amended return because the IRS had an expedited procedure for processing those. The problem is right now is the IRS will need to update those forms because they're still set up for the old 3-year carryback, and the instructions say you can't even do it unless you're an insurance company or a farming business. Ultimately, you've got to file this, and you're waiting on the IRS to process it. So it may take some time before this puts cash in the business owners. I think that's the challenge.
Another quick thought, maybe two, is clearly some of the benefits we're going to talk about in a minute might generate losses in 2018 that don't currently exist. You may have a profitable 18 year, but when you hear some of the other material we're going to go over, it could create a loss in 2018. And then secondly, when you carry the loss back, you still have that AMT 90% limit, which means essentially you'll get 90% benefit of your NOL in an earlier year, and you'll lose 10% probably due to AMT.
No, all good points. All good points. The additional limitation that was lifted through the CARES Act, focusing on those non-corporate taxpayers who had losses that were being generated, business losses that they were using to offset non-business income. The tax reform imposed limitations to where essentially, like the 80% limitation, those taxpayers could not completely offset their non-business income with the pass-through business losses. The CARES Act for tax years, business losses generated in tax years 2018, 2019, and 2020, those can now be used to fully offset non-business income. They're no longer subject to that limitation. And in addition, this is with respect to any losses, not necessarily losses that were generated or a result of the current pandemic. So to the extent you had prior years where taxpayers were subject to those limitations, were unable to utilize those, you can now go back and fully offset those losses as though that limitation is no longer applies for those tax years. And to Rick, to echo what you said, I mean, in this context and thinking of the process of amending and seeking these refunds, again, as Rick pointed out, taxes had to have been paid in the prior years for you to get any economic benefit through a refund claim. But there was also concern on the partnership side that given the new partnership audit rules and the way refund claims are now submitted, processed under those rules, that what does that mean for those involved in pass-through entities that are subject to the new centralized audit regime under the new audit rules? To the extent that you're not even permitted to submit an amended return, you have to submit administrative adjustment request. Are you, how will that refund now be filed and processed? And thankfully, yesterday, the IRS issued Revenue Procedure 2020-23 that provides that for tax years beginning 2018, 2019, that partnerships can file an amended partnership return as long as that amended partnership return is filed consistent with the procedures outlined in the RevProc. So it's an amended Form 1065. You're checking the amended return box. You're writing along the top of the return. It's filed consistent with RevProc 2020-23. Also keeping in mind, you'd have to issue amended K-1s to the partners. Question of the partners then having an obligation to amend their individual returns consistent with those amended K-1s. So it is a little bit of complication, some issues that need to be thought through from an administrative standpoint, but it was welcome relief from the IRS that they were considering and responsive to those concerns, and they issued the guidance yesterday. With respect to corporate and individual refund claims, the IRS also issued a statement yesterday basically saying, we'll get back to you. Wait for guidance from us. So hopefully that'll be coming out soon. We'll get some additional guidance as to what this process looks like. But again, to echo Rick's good point, this could take a little while. It's not a process like some of the other provisions with the retention credits and others that taxpayers can take immediate advantage of. There has to be a claim filed, amended return filed, and then it has to be processed, and we'll see how that goes.
Yeah, just a practical point, the excess business loss, they did make that, that's for 2018, 2019, and 2020. So if you were affected by this, you had a loss limitation in 18, you definitely have an amended return opportunity and a refund opportunity. Our challenge is our software won't be fixed on that until later in April, we understand it. And you would think, just override it. But, these days in electronically filed returns, it's got to be, approved for electronic filing. So we really need that software update to be able to process even an 18 amount on that. So yeah, it's a helpful, I think this was necessary, to fully take advantage of the NOL provisions that you were talking about. They needed to get this loss limitation out of the way as well. So thankfully they did that.
This is that $500,000 loss limit, just so folks can sort of hear that. I don't know if you mentioned that, Chris. That was
for a married couple, $500K a year.
500. you couldn't offset non-business income with business losses limited to 500. Anything excess of that was carried over. So that's what this is regarding.
That's exactly right, Stephen. Yeah. All right. Well, I think we turn it over to the good folks at MCM on the next slide.
Sure. One other thing that was in the Tax Cuts and Jobs Act that was effective back in 2018 was they did away with the corporate alternative minimum tax. And they didn't do that for individuals, but they did do it for corporations. And if you had paid alternative minimum tax in any prior years, you're able to carry that over to offset regular tax in future years. So when they did away with the AMT, they had to create a mechanism where those AMT credit carry forwards would be of some benefit to taxpayers. So what they were allowing you to do was to offset your corporate tax with AMT credit fully. If you had an excess of your credit over the tax, 50% of that was refundable each year. And then finally in 2021, any remaining amount they were just going to give to you as a refund. So what they did here in this bill, this legislation, was they essentially accelerated that to the current year, 2019 filing year. So you can go ahead and claim that on your 2019 return. And in fact, I think you can elect to get this as a refund on your 2018 return. So this is just an acceleration of that benefit that taxpayers were going to get, another way to get cash back to businesses to hopefully pay payroll or do what they need to do. All right. Another Tax Cuts and Jobs Act limitations. This goes back to the 2018 tax years when this first came into play. But the TCJA put into place a limitation on deducting business interest expense for taxpayers. You did a calculation. You looked at taxable income. You got to add back interest, depreciation, and amortization, and then you applied a 30% limit based on that adjustable taxable income amount. And that was a limitation on the amount of business interest a taxpayer could deduct. So what they're doing here is they're increasing 30% to 50%. They did that for all entities and all taxpayers except partnerships for the 2019 tax year. For partnerships, they delayed this a bit. You're not going to be able, you're still 30% limit for partnerships for 2019. If you have a limitation in 19 at a partnership level, they're going to allow the partner to deduct 50% of that immediately in 2020, and then perhaps more in 2020 if the taxpayer had enough income. Unfortunately, 2020 might be a difficult year, so I'm not sure exactly when partnerships may get to deduct that. It depends on their situation, but also very, very helpful.
I will say too, it'll be interesting to see, state conformity to that deduction, if there's going to be conformity to the changes. A lot of states have, rolling conformity to the code. And so that'd be something to look at what states do with it. Is that more opportunity? Is that more cash? Or is that just more of a headache if they don't change it and they don't conform? Because it's just more of a kind of a compliance burden really on the state level. So just something to be thinking about as well and seeing if states kind of react to that at all.
We agree. I agree with that. You want me to hit the QIP?
That's you, sir.
Okay. So this is the deduction that we were discussing earlier that might generate potentially losses in 18 and 19 and perhaps even into the future. This is the so-called technical glitch that existed in the Tax Reform Act in December of 17. So effective 1/1/2018, interior improvement property known as qualified improvement property for commercial buildings was no longer eligible for bonus depreciation because there was a technical glitch in the Tax Act. that should have required an ink pen, but it actually required action by the Senate. And the Republicans and Democrats couldn't agree, so it remained broken in that it was intended that you could take bonus depreciation on interior improvements in the law effective 1/1/18, but the way it was written, it was prohibited. So with this recent CARES Act, that's now been opened up and corrected. It's improved. It's even better. And then related to the improvement, though, there's a number of issues. So where are we? Effective 1/1/2018, interior improvements for commercial property other than multifamily, apartment complexes, single-family residences. This is commercial, retail space, office space, industrial buildings. The interior improvements are 100% bonus eligible. So it's an immediate deduction. We have clients, as an example, who placed millions in service as interior improvements, and the tax life on that was 39 years. In other words, it was pennies. Now the deduction is going to be year one. So here's a few challenges that as a firm we've been discussing internally, and I won't get into all of these because it's a lot. So one, if you had interior improvements in 2018, the general answer is you probably want to amend 18 and take the 100% deduction. If you had interior improvements in 2019, the general answer is you probably want to amend 2019 and take the deduction in 19. There's a possibility, and this is what Chris Kaufman was referencing earlier, the IRS released rules for partnerships. It's actually partnerships subject to the centralized audit regime. The partnerships not subject to the centralized audit regime, 1120S's, individuals, corporations, 1041s. We don't have the rules on how to do this yet for qualified improvement property. They issued it for a narrow thing for partnerships. But nevertheless, just some thoughts so those on the line can sort of hear this. The general answer is you probably want to amend. You could potentially do a change of method of accounting and take the deduction in a future year. So you were entitled to it in an earlier year. You didn't claim it. So you could do what's called a change of method of accounting and deduct it perhaps in tax year 2020 as an example. It's called a Form 3115. What if, though, you elected out of bonus depreciation for that tax life in tax year 2018 and 2019, and you made an irrevocable election out of the bonus? Now you're eligible for bonus. How do we handle that? We think guidance will probably be favorable to that answer. What if you are eligible to claim the deduction in an earlier year and you didn't elect out a bonus, or you're required to go back and actually claim it because bonus applies and you didn't formally elect out of that? We're probably going to need guidance on that answer. If taxpayers made what's called an ADS depreciation election, these are all kind of fun things accountants have to deal with, and this one actually is a little bit of a blister. If an ADS election was made, that was to kind of control this interest expense limitation that Rick was discussing a minute ago. So if a rental real estate operator developer fell prey to this interest expense limit and they were unable to deduct a certain amount of their interest expense, a way out of that was to make what's called an ADS election, and it would just lengthen the depreciable life on your property from 39 years to 40 years. Generally, that's the general answer. And then your interest expense would be 100% deductible. So the point is, for many of our clients, we made an irrevocable ADS election, increased the tax life of our depreciable property from 39 to 40 years in order to take 100% of the interest expense. Well, now making that ADS election, the way the law is currently written, that prohibits, you're prohibited from now claiming bonus depreciation in the year which you made that ADS election going forward, and it's irrevocable. So if you made, for example, the ADS election in 2018, you're prohibited to do bonus depreciation in 18, and guess what? You're prohibited to take it in 19 and 20 and into the future. You're prohibited on that particular entity for which you've made that election. So the point is, we're waiting for hopefully favorable guidance. Rick Woods has assured me we're going to get favorable guidance. And because it should,
I'm a glass half full kind of person.
well, I know it, I know. So I'll get off of this. The good news is this is going to be a substantial deduction for many clients. Many taxpayers believe this handle the legislation, which everyone agreed it was, and now they fixed it. But we've got a host of issues pursuant to the fix.
Even the only thing I would add is we do think that, you know, guidance, et cetera, but the taxpayer is going to get the benefit of this. And then I think we're going to have some options on what year that they get the benefit, which may matter, you know, for one thing, state and local taxes, you know, it may make a difference what year we want it to run through. The taxpayer already has a loss in one of these years. You know, the local occupational tax, the difficult thing about it is there's no carryover at all. So it doesn't help you at all to take it in a year where you already had a loss from an occupational tax standpoint. So we might prefer to push that off in a year where we had occupational tax burden. So it's just going to be situational for every client, what year we want it to run through. So we're going to be planning carefully around this.
Yeah, the bottom line is there's going to be flexibility. You likely will have the ability to amend, take it in a year with which it was incurred, or even though the expenditure was incurred in a particular year, you take the deduction in the succeeding year, maybe when you want it or need it. So you'll have some flexibility.
Just moving on to the next subject.
All right. The employee retention credit. This, you know, not to be confused, you know, we talked about, we're focused on the phase 3 bill, the CARES Act today. There was the phase 2 bill, the Families First Coronavirus Relief Act, provided for paid sick leave in that bill. And it was something mandated upon employers that were less than 500 employees. And it was mandated on employers, but yet the employer could recover that by getting a payroll tax credit against the employer share of the payroll tax. This is very similar to that, except that, you know, the phase 2 bill limited that to employers that were under 500 employees, where this, in the case of the employee retention credit, as I understand it, it applies to any employer of all sizes. So it's meant to incentivize employers in keeping the employee connected with the business to the extent that the employer and their business is affected by COVID-19, if they're shut down, et cetera.
Yeah, and just one thing, I would agree, the employee size limitation does not apply to the retention credit like it applies to the relief credit that was under the prior phase of legislation. And to also point out on the payroll deferral we talked about earlier, there's no employee limitation on that as well. So on a lot of these relief provisions, you see employee limitations of 500 or less on the employee retention credit and the deferral option that we discussed initially. There's no employee size limitation. In addition, the prior credit that Rick was referring to, they're not exclusive from the extent that you could an eligible employer could claim both the employee retention credit and the payroll tax credit. You just can't claim them for the same wages. But you could utilize both to the extent it was beneficial in evaluating, you know, how the use of both could be helpful in the particular facts and circumstances of that employer.
Yeah, and I will say too, kind of a caveat to both this and the deferral credit we talked about before is if you are applying for and approved of and are forgiven for a paycheck protection program loan, these may not be allowed. You may not be able to take these credits, the deferral or the retention credit, if you are forgiven for all that payroll protection application program. Now, I understand it is if it's forgiven as well. So keep that in mind. And it's something we've talked about with GLI. We can send this out afterwards, but our firm developed kind of a chart that shows, okay, if you go this way, what does it exclude? You go this way, what doesn't exclude, stuff like that. So we can send that out as well. It's kind of an easier guide to look at, the prior under the Family First credit, the sick leave credit versus the employee retention credit versus the payroll, what can and can't be used. So that can be helpful for people that either have applied and are still waiting to hear, and those that may eventually be approved and be forgiven. So something to keep in mind on that end as well.
Just moving into the individual benefits.
All right. One of the much talked about really hallmarks of the CARES Act were these 2020 recovery rebates for individuals. Provided $1,200 per individual, $2,400 for a married couple, and then an additional $500 per child. One of the limitations of this is it phases out at certain income thresholds. Ultimately, a married couple earning over 198K would not be eligible to receive this. My understanding is if you filed your 19 return, they're going to base it on that. If not, they'll look back at your 2018 return. Ultimately, this is going to be a credit on the personal tax return that gets sort of reconciled at the end. So, but they are advancing, and as I understand it, they're trying to get this in the hands of citizens as quickly as possible. So folks may start getting checks here in the next couple of weeks. And I think they're trying to, as much as possible, get those deposited in bank accounts if they have that information. Social Security recipients perhaps will get that in, based on where their Social Security check is deposited.
And said too,
folks are excluded. Go ahead.
No, you're fine. You're good. And you said it's either based on your tax year 18 or 19. I think you might have said that, but nevertheless, we got clients suggesting, if 1 year was, and they were more or less out of the consideration, and they want us to file their 19 return, which is perhaps, what I'm trying to do. So it's better.
Yeah, absolutely.
Okay.
You can't get this if your claim, my college age son was wondering if he was going to get a check, and I had to explain to him that he's my dependent. So I don't think he's going to get it. He was disappointed, but here's a list of folks that are not eligible. If you're a non-resident alien, a dependent, not for estates and trust, and then also you have to have a Social Security number as well. So those once again a centerpiece of the legislation. Okay, this provision affects retirement accounts, and generally, if you make a withdrawal from a qualified retirement plan, an IRA, et cetera, and you're not 59 and a half, there is a 10% penalty for early withdrawals. And what they're attempting to do is for folks that are affected by COVID-19, allow them to withdraw from their retirement account on a penalty-free basis. And in fact, not only the penalty would be waived, but you get a 3-year spread on dealing with the tax burden on that. And if you're able to return at some point any of the funds into the account, perhaps you can avoid tax altogether. So once again, this is a nice provision for those who are directly affected by COVID-19 can take advantage of this. When I mentioned those affected, here's the criteria. Either the recipient of the distribution was themselves diagnosed with COVID-19, or a spouse or dependent, or if they had adverse financial consequences as a result of being quarantined, furloughed, laid off. That's another situation where they can take advantage of this provision. Okay. There's also an opportunity to make charitable contributions and receive a benefit. That's been enhanced under the CARES Act as well. You know, historically, individuals were limited on how much they could deduct as far as charitable contributions. Cash contributions were limited to 50% of adjusted gross income. Well, that's been set aside for the 2020 tax year. You know, it may be a year where folks have less business income, they have losses, so potentially that could impact their ability to deduct charitable contributions. That could potentially affect nonprofits. So to prevent that from happening, they've set aside the 50% limit for 2020. For corporations that historically had a 10% limitation, that's been increased to 25% of taxable income. So, you know, to some extent, this is helpful. It's a very good year to make at least cash contributions to charity and receive a tax benefit. Additionally, you know, the Tax Cuts and Jobs Act, you know, a lot of folks no longer itemize deductions because of the increase in the standard deduction. To encourage those folks to still make charitable contributions, the CARES Act created a above the line deduction. Even if you can't itemize, you can claim up to a $300 deduction for cash gifts to charities in 2020.
All right, this is Daniel. I'll take over. So in addition to the specific, you know, federal tax provisions under the CARES Act that we focused on today, and has been the most highlighted and the most important in most respects, one thing to be thinking about as well is what's the state and local tax effect, not only of the CARES Act, a few things we talked about today of state conformity and issues related to the CARES Act, but also how are state and local agencies, tax agencies reacting. They're in the same way. It's kind of normal to where, you know, federal reacts, then state reacts, and typically, you know, local level can react as well. So kind of want to go through a bit of that for what Kentucky's done so far, as well as what Indiana has done, and then some other things to be thinking about from the state and local tax perspective. So in Kentucky specifically, if you've been listening to Governor Beshear every day give his speech and his talk, and updating things. One of the things that was done just on the 30th, so not long ago, a little over a week ago, was a specific relief bill, Senate Bill 150, that was enacted. And what it did was essentially what a lot of states are doing, Kentucky's not unusual in that end, is they've officially, took a while to get it confirmed, but they officially extended income tax filing deadlines to July 15th. And basically, the executive order and then the bill itself stated that it would follow, Kentucky would follow all extensions provided by by the IRS. And so it makes those provisions. Now, it doesn't make all extensions for all tax filings or all tax payments, and we'll go through that in a minute, but it does specifically, they've expanded upon that since for income tax purposes for individuals, but also LLET, corporate income, fiduciary returns, and pass-through entities as well. So that's you know, not necessarily cash in your pocket by any means, but at least reduces some of the burden that businesses have to deal with during this time period when they're worried about other things. Another thing that was done, the Department of Revenue also confirmed that business personal tax returns, the deadline was, you know, May 15th typically, is extended now to July 15th. And that specifically, they say on their website, it's really not just on their website, it's for Form 62A 500. So that's most business personal property tax returns. Some questions I thought about is, you know, does that include PSC property tax returns, which I think there's one due, I think April 30th, because that's a different form number. I would assume that would be included as well, but I haven't seen anything officially from the department. Another thing, maybe commercial watercraft is technically a different form. So you would think that would be extended as well, but you don't know for sure, at least to this point. So it's something to be thinking about if you have any of those different types of filings that are beyond typical business personal property tax returns. Also, as part of the Relief Act in Kentucky, a relief bill was the waiving of all interest, which penalties can typically be waived with late penalties for something like this. It's a reasonable cause situation. They specifically allowed the waiver of interest, which is typically not allowed in Kentucky. So that's a good thing as well if there is filing late. Also, it's authorized localities. The bill itself authorized localities to extend or suspend local license tax returns. So like Rick was talking about earlier with the local license tax, there's so many caveats and issues with that. One good thing is that they have authorized that. Now, not every locality has necessarily done that already, at least publicly. Metro Louisville has, they've already said they've extended it. The OL3 return to July 15th as well, typically do April 15th. And did some other things. So the KYCPA, actually, if you go to their website, they actually do have a listing, a current listing, or as current as it can be, of a spreadsheet of the different localities that have agreed to extend or suspend OLT returns or payments. So that's another thing that's good. Also on the under the bill, a little different, not necessarily tax, but for unemployment insurance purposes, businesses are concerned, what if I have to lay off all these people? Is that going to really affect my reserve ratio? Is that going to shoot up my unemployment insurance rate? Well, under the bill itself, it allows for the reserve ratio relief if it's related, if layoffs are related to COVID-19 issues. Now, there's more specifics that probably need to go with that, more guidance, but that's something to at least ease the minds of businesses that may have to let people go, at least for a time being or temporarily, whatnot. And then finally, more of an administrative issue, the bill itself allowed for state and local agencies to waive licensing and renewal applications and other administrative fees that are required for engaging in business. So think about your annual license tax fee in certain cities and certain counties, applying for business application or renewal, things like that you may forget during this time period or just don't have the time to do. There's more of a release on that. So that, again, more relief in general may not be cash in your pocket, but it's something that can help businesses. And I know at the local level, at least in Louisville, I know Iris and Charles have been working very hard to find other opportunities at the local level for other kind of tax and other kind of relief measures for businesses. So hopefully stay tuned for more on that. Next, with Indiana is similar. They recently released what's called their Helping Hoosiers Relief Guidance. Similar things, they have extensions for filing and payment of individual and corporate and estimated filing payments to July 15th. Also extended registration for your annual registration as a retail merchant for sales and use tax purposes. That's pushed off to June 30th. Also, they've got a wide variety of penalty adjustment abilities for late filing and payments. Now, just with everything going on, you've got a good chance, even if you do miss extensions, to have that ability. One thing I will say, Indiana is a little bit different. Property taxes are still remaining due on May 11th. But as part of a way to mitigate that, they've said that no penalties for late filing within 60 days after that. So it does provide some extension on that measure, but not totally, like Kentucky, that extended it further. And then, in Indiana, property tax exemption applications, which I think are due in April, have been extended. So that is one extension related to property taxes, but maybe not as important. But one thing to note, for the extensions, that does not include business trust filings and payments. So if you have business trust filings and payments in Indiana, those still, according to the FAQ in Indiana's Department of Revenue, will still continue on that monthly basis. Other options they give: expedited refund processing. They've said basically they're going to continue their refund operations, but also reallocate resources that normally aren't there to help expedite refunds. So if you've already claimed a refund, or if you're going to, now's the time, because they're going to do it quicker and faster and hopefully be a little bit more friendly. Debt collection relief, they're not going to come after you for any new tax bills currently with warrants or liens or levies. A little bit more flexibility if you are currently in a collection case, or if you're in an installment plan, there's more extensions for longer months, things like that. So they're really trying to relieve the collection level, which is important in Indiana because they have a third-party collection agency that they can kind of turn loose on a lot of those questions and issues. So that's a helpful thing. Audit and legal protest relief. So they're kind of suspending all in-person field audits. They are continuing some desk audits, but more of a virtual perspective and tailoring those back as well. suspending in-person protest hearings. One important thing that Indiana has, that Kentucky has, doesn't have, at least that I've seen so far, is that they're extending the protest window. So in Indiana, if you're protesting or challenging some sort of tax bill or tax assessment, you now have 120 days to do that rather than 60, whereas Kentucky, I think, is still at the 60-day mark. So Indiana's looking at other ways to make sure to help businesses. Hardship and offering compromise support, again, allowing extensions for that and just being more open to a lot of those issues. And then continued customer service operations. Basically, they're operating as normal other than in-person issues. And then kind of for the next, this is kind of the last real estate and local tax issues I wanted to bring up. So as I kind of intimated earlier, this is not just for, it is mainly these extensions, these filing extensions and payments are mainly for income tax related returns. But they don't include typically, most states, including Kentucky and Indiana, there's no sales and use tax return extensions or reliefs or anything that I've seen so far. So that's important to be aware of, that those are continuing to be filed. Indiana does have a little bit of an exception for a use tax now for any donated medical supplies for COVID purposes. So there is an exemption there for use tax purposes in Indiana. Kentucky has basically said, you know, we need you to start doing everything electronic. And that's kind of the relief so far, maybe more in the future. But for now, that's all there really is. Also, don't sleep on refund claim deadlines and other deadlines that aren't claimed. So, you know, each state has specific refund claim requirements, you know, at the state and local level. Kentucky, typically it's about 4 years, besides property taxes, 2 years. So, you know, if you have statute of limitations or issues with refunds coming up, you can't bank on any kind of extension for a statutory limitation or a refund period. So be thinking about that. It's included for federal as well. Other things, you know, tobacco filing, tobacco product filings, things like that. Again, protest deadlines, be aware of that. That still remains. In Kentucky, coming up is real property tax appeal season. So the first basically 2 weeks of May is when you can appeal your property tax values. For now, I haven't seen an extension in that whatsoever, especially in Jefferson County or in Louisville, because it's all online. And so be aware that that still will be in place as far as I know. Now, it may, things down the line, the BAA hearings and things in person may get delayed based on everything, but that's still going on. So just be aware of all these different things, that not everything is extended at the state and local level. And quickly, there's, you know, some other states, every state's looking at different ways to help in addition to what I've mentioned, more settlement authority, different things in Tennessee with their unique taxes. Tax credits in one state for the manufacturer of PPE is an interesting one. And kind of going into my last intro is, you know, one thing to be thinking of are there new nexus concerns if you have employees telecommuting or working from home that are working from cities or counties or areas that they're not normally. Does that create nexus from a state and local tax perspective? Some states have come out initially and said, at least administratively, no, we're going to give you a safe harbor. We expect more states to do the same, hopefully, but we haven't known for sure. Indiana, I just saw a day or two, did an FAQ where they specifically said, yes, you know, in these situations where you have employees working from home because of COVID, you know, there's not going to be any issues to where now you have nexus in this area. And so that's good from an Indiana perspective. Kentucky, I haven't heard anything. And it's also from a local occupational license tax perspective. Think of that if you have employees all over the state in different cities and counties that may have these local license tax, maybe the local level sees that as additional income and, you know, and goes after that. They don't really have a lot of the resources to do that, but that is something to be concerned at in the Kentucky level. So more to come on that, hopefully more relief, but something to be thinking about, each necessarily tracking, but be aware of where your employees are over the coming weeks and the past few weeks from a nexus perspective of do you have to be filing in a certain area, registered or paying in certain areas. So that's kind of a high level overview of the state and local tax effects that I've seen directly or have been aware. And it just, every day there's something new. So the good thing is they're all being, you know, very proactive, it seems like, for the most part. And if there's a time to ask for, you know, relief, now's the time. So it's, even though they may have limited resources at the Departments of Revenue, you know, it may be a good time to do that because they're really wanting to hopefully push stuff out and give relief to businesses and taxpayers. So that's kind of my thoughts. If anyone has any additional thoughts on that end, Chris or Rick or anybody. But I wanted to bring that up in addition to the federal tax perspective of the CARES Act.
I think it's all good points, Daniel, and important to realize as we think through the federal impact of all this and work through with your advisors and your tax professionals, that there is the state and local impact as well that has to be considered. And the points that Rick raised earlier about taking certain tax positions, thinking it through, and all the good points that you raised, Daniel, in that summary. There's a lot of things that have to be contemplated and considered. It's not a simple process, but hopefully, in working through a lot of these issues and working with your tax professionals, businesses can find ways to get some relief in these difficult times. Unless anyone else has anything to add, Sarah, I know we've talked about a lot, and so I want to keep some time for answering questions. And so I think we're open to questions from anyone listening.
All right, and just as a reminder, please everyone submit your questions in the chat just to get us started, since we don't have any in there quite yet. We know that several distilleries have modified their operations to produce hand sanitizer. Can you explain how this temporary waiver of the federal excise tax works, and will it have impacts on anybody other than the alcohol industry?
Yeah, the specific excise tax that you're referring to, Sarah, would apply specifically to those people dealing in distilled spirits subject to the tax. So, relief in that area would not be relatable to anyone that isn't specifically subject to that tax. So that's kind of an industry specific tax relief there. That's related to the removal of spirits and use. There's certain taxes that apply as those items are removed and used and utilized in kind of commerce. Those taxes are imposed, and so to the extent that they're being used for a different purpose and purpose to assist others in the relief process, that's limited specifically to that industry. There may be other types of taxes imposed that would be impacted due to businesses converting. I don't know if anyone else, on the panel has thoughts of potentially other types of taxes similar that maybe states or the federal government could offer some relief in that context.
Hearing no other thoughts, a quick question here. What are your thoughts on overpaying on the extension in July for the 2019 year in order to cover Q1 and Q2 estimates?
I'll chime in on that. My understanding is, so we got relief from Treasury and IRS with respect to for filing. Initially, they put out that you were going to be able to file your return in July and defer federal tax payments up to a certain threshold. And then ultimately that became confusing. There was pushback, and ultimately they decided that the deferral would be not only filing to July 15th, but also payment. So any income tax payment that is due April the 15th can be deferred until July. And that applies to the 19 balance due. It also applies to your first quarter estimate that would also be due 4/15 of 2020 with respect to the 2020 tax year. So, there's nothing wrong with paying tax early. The point I would make there is that you don't have to pay that Q1 estimate until July 15th. So overpaying 19 means you've overpaid, as of right now. So, you put more money on deposit with Treasury and IRS than you really needed to. So just keep that in mind if that's something that you want to do. But you do have the opportunity to hold on to that Q1 estimate until July 15th. Now Q2, as of right now, is still due June 15th. So it's odd that now your second quarter estimate is due before the first quarter, and maybe they'll change that at some point.
Great, thank you. If you are a non-Louisville resident and currently working from home due to COVID-19, is there a form you can file to the city and receive a refund on some of the Louisville taxes paid from wages for days worked outside of Louisville?
I think there is an application for employee refund. I don't know if it would be tailored enough for this. Typically, it's switched between the different rates, but that's possible. Yeah, that may be a way to go about it. I have to look at the form itself, but there is a specific form if you go to Metro Revenue's website that allows for an employee refund on overpayment, essentially. And it could be argued, depending on how long this would be, that would apply if you're working from home and not in Louisville for an extended period of time or the whole year or whatever the case may be. So it's a good point, and there definitely is a form. I wonder if it'll be updated, but if not, it's worth a shot, I think.
Daniel, I agree. This is Stephen. We file that on behalf of some of our clients. So if you're a wage earner and after you receive your W-2, just as you're noting, Daniel, after you get your W-2 in the succeeding year, you can attach your W-2 to this form that Louisville Jefferson has, and you can note the number of days that you were outside Louisville Jefferson and your employer over withheld the Louisville Jefferson tax because you were outside and that wasn't reported to your employer, or there was an inability for some reason. Maybe the employer didn't want you to, you were unable to do that. In any case, you can get a refund for overpaying your Louisville Jefferson tax. Absolutely.
I just say it may be interesting to see, piggybacking on Daniel's point earlier, though, about creating nexus in various locales. It may be interesting to see how the city and other jurisdictions respond to that. Maybe there'll be some type of requirement that you show that you, in fact, were submitting and paying tax in the jurisdiction in which you live. Creating a situation where basically you would have no tax from any location. Like if you're working and living in a jurisdiction that doesn't have a local license tax, that's one thing. But to the extent that typically you're not subject to the tax in your location because you're coming to Louisville and working, whether Louisville or other jurisdictions would want to see it go both ways. Basically, you're not taking advantage of the situation.
I agree with that, Chris. One thing to note, I believe Louisville Jefferson might be the only, it's clearly one of the few that permits employees to file a form and receive a refund.
Great, thank you for that clarification and that information. Within the CARES Act, there's the ability for some employers to assist with student loan repayment. Can you go over those repayment benefits and how they work? I'm going to try to touch on a few questions that we keep hearing multiple times, and some of these I know you've already addressed, but just want to go back on some of the highlights that we keep hearing.
I can try that at a high level. I think the way I think that this works, and you guys chime in here if you think I'm off track, but generally the employer is paying the amount toward the employee's education. And, generally when you're an employee, you receive a benefit like that. So even though you didn't receive the cash, it was paid on your behalf, it would normally be taxable income to you as an employee. This is an opportunity for that to be tax-free to the employee, I think, up to a certain limit. Does that sound right, guys?
Yes, it's like $5,400. I agree with you, Rick. I think it's 54.
It's
7.
it's 5,250.
Yeah, that's it.
It's tax. The employer is permitted to pay it to the employee, and it's
Yes.
taxed to the employee, but the employer is not, it's my understanding, is not able to deduct that amount. It's not a deductible expense to the employer, but it's tax-free to the employee. But
Okay.
Another question that we hear quite frequently is with the employee retention credit. If some of these provisions are only available if a business forgoes or is not qualified for the Paycheck Protection Program, if Congress acts and expands the PPP eligibility, how would you counsel a company that initially was seeking these tax credits but now wants to consider triple P? And what are the timing considerations? We keep hearing this question quite a bit, actually.
You want me to give a quick stab at that, Rick, everyone?
Sure.
I'll probably be wrong, but I'll give you, I've thought about some of this myself. So one, on the sick leave, where, you know, you have that 2/3 of the $200 and all those kind of calculations for employees who are away or, you know, anyway, if, as an example, if an employer has 50 employees or less, 50 or less, they're entitled to that sick leave payroll tax credit if they simply believe their business has experienced some detriment. In other words, it's an extremely low bar for you to claim that payroll tax credit, extremely low bar. So in any case, what would you do if you were in the process of maybe saying, I'll take advantage of the credit, and now I really want to take advantage of the loan? So one, keep in mind the payroll tax credit for the sick leave benefit, you cannot start claiming the credit to the second quarter of 2020 anyway, which in other words begins the month of April. So you're right here in the beginning of reducing your otherwise required payroll tax deposits. You're reducing your payroll tax deposits today in anticipation of when you file your 941 in July, that your tax will be less. So my short answer is, if you happen to pay a few deposits less today, thinking you're going to claim that sick leave credit, and you instead want to pursue the loan, then just catch up your payroll tax deposits. Probably you could write a letter and explain what happened, and I'd be willing to bet the penalty would be forgiven because you instead chose to pursue the PPP loan. So that's my answer. I mean, you can come out of the gate with the sick leave and then catch up your deposits and then pursue the loan.
I guess one thought I have is the fact that you use the sick leave credits would not preclude you from pursuing the PPP loan. It's just that those amounts, those credit amounts would not be included in the PPP calculation for debt forgiveness. So there'd be some portion of that could not be forgiven. But so it's really, in essence, you would be making up you wouldn't be able to get the benefit on both ends. So it'd just be a recalculation, a reduction of the amount that's calculated for purposes of the debt forgiveness under the PPP loan. It just wouldn't preclude you from seeking the loan. You just may have a portion that's not forgiven under the terms of the loan.
That's a good word, Chris. I appreciate you clarifying that. Thank you. So it might end up where a business receives the loan, but it's not going to be forgiven, and that portion would just remain as a loan.
Yeah.
If they chose to do the other, the sick leave.
I think it's a great question, and it really just drives home how where these various beneficial provisions, where they intersect, and how to choose or optimize it's so situational. I think it's really hard to generalize about that. Would you guys agree? I think it's so fact and circumstances dependent that it's going to require a lot of analysis to really answer those kinds of questions.
Well,
Yeah.
One of the things, not to get into the weeds of this, is if we talked about this earlier today as a firm, and I know many are doing the same thing, and that is once you receive your loan, your PPP loan, there's calculations. Just because you spend it on employee salary, that spend doesn't necessarily mean that piece will be forgiven. So there's all additional calculations on the back end on that 8-week period, how that spend is made.
Yeah, and that's why for us, we've kind of put together an SBA team that focuses on all those details. We're kind of having a cross-sec between Chris and I and our tax group and the SBA team, who, SBA loans in general are kind of unique, to understand the ins and outs on the SBA side of when it's available, when it's not, how's it precluded. And so, we're having both sides on the tax side and the SBA lending side of our firm, going back and forth of what we think the right answer. So it's developing. I mean, it's just, there's no, like you said, Rick, there's no specific easy answer. And it just sometimes it requires a little bit of digging into knowing the rules on the SBA side and knowing the tax side, and then the facts of the actual taxpayer themselves. So it's complicated. I mean, it's been a crazy last 2 or 3 weeks, and it's just getting started, it seems like.
Definitely a very complex thing. And, we're probably looking at this for quite some time. This is definitely going to be what appears a long game, and it's going to take some time. I know there are several more things they're thinking about doing at the federal level. Another question, I know you touched on this a little bit, but we're thrilled to see the qualified improvement property changes, especially because we have a number of restaurant chamber members. So you mentioned how this works, but for those of us on the line today that are interested in making these investments now, are there any special considerations or additional guidance that you might want to touch on in that area?
So someone would want to make the interior improvements today? Is that what I'm hearing, Sarah?
Yes, or the near future. I recognize that most things are shut down at the moment, but getting planning underway, that kind of thing.
All right, good. So clearly you make interior improvements to real property. It could be a manufacturing facility, anything, as long as interior, other than, like we mentioned earlier, apartment complexes do not qualify for this. But nevertheless, yeah, you make the improvements in 20, you believe it's going to generate a loss for tax year 20, then when that 20 tax return is prepared and filed, you can take that loss, if it flows down, for example, to your individual return, and you have a loss on your individual return overall, you can carry that 20 loss back 5 years. So that would be the advantage. There'll be no immediate advantage other than you could reduce your otherwise income tax payments that might be due for tax year 20 because you're having a big depreciation deduction. But in addition to that, you could carry the loss back.
Great, thank you for that additional information. Just a reminder, if you have any questions, please enter those in the chat box. Another question while we're waiting for people to enter their other questions. So if a business is interested in the delay of payment on their payroll taxes, how does that work exactly? How does somebody apply for that? Or is it something you apply for? Is it something, how does it work exactly for those who might not know?
My understanding is it's going to be incorporated into your payroll tax filings, your 941s, and administered that way. I don't know if you guys got something else to add, any insight there, but I think that's the idea, is it'll be reconciled on your 941 filing.
Yeah, that's what I've heard as well. Yeah.
Yeah, that's also my understanding, but important to note, I mean, it's not something that necessarily has to be applied for or approved, or there's no time lag. Rick is right. You're filing those quarterly 941s anyway. You're required to, and so you're able to take into account that deferral right away, and that reporting will be captured. It's our understanding on the form. There'll be some line entry to address the deferral of an employer's portion of that amount. And one other thing to add to that, Sarah, and I don't think I addressed this when we were going through the initial slides, is that it's also available to self-employed individuals. So to the extent that you're self-employed, and to the extent, some partners in law firms or accounting firms may also be considered self-employed as a partner in or member in their LLC or other entity or partnership. It is a deferral that a self-employed individual could factor in. It would still be that 6.2% of the 12.4 Social Security percentage, the 2.9% Medicare, the additional 0.9% Medicare on amounts above 250,000 for a joint filer, or 200,000 for an individual filer would not apply. But that 6.2% up to 137,700, a self-employed individual could also seek to defer that amount, factor that into their estimated payments, and again, would be subject to the same repayment of that deferred amount by December 2021, December 2022.
I agree with that.
Great, thank you. And I know Iris has entered into the chat box for any other resources or to contact us, please go to our website. Speaking of websites, what websites do you use for guidance, and are there any other resources that you encourage people who are participating today to utilize, and how do they contact you if they have additional questions?
And just speaking for Frost Brown Todd, you know, we have a COVID-19 response task force that's put together a specific website or materials on their access through our website and through a specific link. We're happy to share in the follow-up email that has the slides, but we've been populating that website with a lot of different information across the vast industries and specialties that are impacted, employer issues, SBA loan issues, real estate issues, securities issues, you know, corporate transactional issues, tax issues. You know, so we have a variety of different specialists in a lot of different areas, putting some very tangible and relevant guidance together. It's populated on a daily basis with new information. You know, so that's been one area that we've driven a lot of clients to, and tried to get as much information out there that's practical and helpful in difficult times to get answers, questions answered on behalf of clients.
And I will say too, from a state and local perspective, the AICPA website has a running chart that they update daily basis on what every single state is doing. You know, new executive orders, new laws, new administrative guidance on all of these things that change on a daily basis. So if you have multiple state, you know, compliance issues or concerns, that's a good one, just because there's so many states and localities. That's a pretty good one to kind of keep up on a national level that I've been using and looking to.
Our firm has a similar resource to Frost Brown Todd. It's updated at least daily. And so we have teams dedicated to the different, you know, industries, et cetera. So it's pretty comprehensive. And they're meeting just as probably as often as your team is meeting Chris and Daniel regarding these matters often.
Excellent. Well, thank you to each of you for your expertise today. We are working to get through this together, and we're preparing for a time after COVID-19. So we thank Stephen, Rick, Chris, and Daniel for joining us today to share their expertise. GLI's next virtual discussion will be tomorrow morning from 9:30 to 10:30. We have Dr. Ruth Carrico with the University of Louisville's Department of Medicine's Infectious Disease Center to discuss the latest from the front lines on healthcare and research happening right here in our backyard. So to join this webinar, please visit our website. For a summary of today's discussion, please visit the GLI website, greaterlouisville.com. Please utilize the resources on our site as well. And I hope you have found today to be as informative as we have. So please stay safe and well, and have a great afternoon.
Thank you all, everyone. Thank you.
Thank you.